A free market economy is inherently chaotic, driven by millions of individual transactions and commercial banks that actively seek out financial risk to generate corporate profit. To prevent that system from consuming itself, a massive regulatory node drops into the network to establish order and enforce stability. In India, that apex monetary authority is the Reserve Bank of India. While commercial banks operate to maximize returns for their shareholders, a central bank operates under a completely different mandate, maximizing macroeconomic stability and public welfare. It acts as the ultimate custodian of the entire monetary system. It oversees the physical paper currency changing hands on the street, and it governs the massive invisible supply of credit circulating through the commercial banking sector. To map how this institution functions, we have to look first at its structural traditional duties, and then examine its highly active role as the controller of credit. Without a stabilizing authority at the top, a distributed commercial banking network collapses under the weight of its own untested financial risks. Look closely at the text printed across these notes. The central bank holds the absolute exclusive authority to issue paper currency in the country. In India, the RBI issues every single note in circulation, with the sole exception of the 1 rupee note. This legal monopoly guarantees uniformity across the nation's financial system and gives the institution total mathematical control over the exact volume of cash in circulation. But printing paper requires public trust. Under the minimum reserve system, the central bank is legally required to hold a specific minimum reserve of tangible assets, like gold and foreign securities, against the currency it issues. Beyond issuing currency, the central bank is deeply integrated with the state, serving directly as the official banker to the government. It maintains the ledgers for both central and state governments, receiving their deposits and executing massive public payments on their behalf. It also acts as an agent, managing public debt. When the state needs capital, the central bank raises funds by issuing government bonds, like the one shown here, as well as treasury bills. Finally, it acts as a dedicated financial advisor, guiding the state on critical economic policies. Controlling the physical printing press while managing the government's ledgers provides the central bank with foundational leverage over the nation's baseline liquidity. The central bank also acts as a strict supervisor to commercial banks. It holds the power to grant operating licenses, and it conducts rigorous inspections to prevent unethical or highly risky lending practices. To enforce baseline discipline, it relies on a mechanism called the Cash Reserve Ratio, or CRR. Commercial banks are legally required to keep a certain percentage of their total customer deposits held aside as untouchable reserves. As the custodian of cash reserves, the central bank physically holds these CRR funds in its own accounts. This guarantees that commercial banks always maintain enough liquidity to satisfy daily withdrawal demands. This centralized account system enables the clearinghouse function. This diagram tracks 3 commercial banks that constantly owe each other money due to millions of customer transactions. Instead of settling these debts individually, all banks route their mutual claims through the central bank. The central bank simply adjusts the internal balances in their reserve accounts. Settling claims mathematically prevents the massive logistical expense of physically moving cash across the country every day. but mathematical buffers can fail. If a commercial bank faces an unexpected wave of customer withdrawals, it can burn through its liquid funds entirely. In that crisis, the central bank steps in as the lender of last resort. It injects emergency capital into the failing commercial bank, protecting the depositor's money and stopping the panic from creating a systemic financial collapse. Reference visual. It extends this protective role internationally as the custodian of foreign exchange reserves. By actively managing an inventory of global currencies, the central bank regulates exchange rates and stabilizes the nation's balance of payments. Through mandatory reserve ratios, highly efficient clearing networks, and guaranteed emergency bailouts, the central bank engineers trust. It takes a highly volatile commercial sector and makes it appear perfectly stable to the general public. All of these structural roles support the most important function of the institution: controlling credit.
By regulating the money supply, the central bank throttles inflation and fuels economic growth. This animated model demonstrates how quantitative methods work. Think of the economy as a closed fluid system. These macro-level tools are the main valves that adjust the total volume of money, expanding or contracting uniformly across all sectors. The first valve is the bank rate. This is the baseline interest rate the central bank charges when lending long-term funds to commercial banks. When the central bank turns up the bank rate, commercial banks face higher costs. They instantly pass those costs down by raising their own lending rates. The cost of borrowing increases, businesses take out fewer loans, and the total flow of credit heavily constricts. The repo rate relies on the exact same chain reaction, but for short-term funds lent against government securities. Raising it instantly tightens short-term credit. Then there is the reverse repo rate. This flips the dynamic. It is the rate the central bank pays to borrow money from commercial banks. If the central bank raises the reverse repo rate, it incentivizes banks to park surplus cash safely at the central bank to earn that interest. They stop lending to the public, which actively shrinks the availability of credit. Next are open market operations, or OMOs. This involves the central bank directly buying or selling government securities in the open market. When the central bank sells securities, buyers pay cash, effectively sucking liquid money out of the banking system. When it buys securities, it injects a massive surge of fresh cash directly into commercial banks, rapidly expanding their lending capacity. Finally, the central bank manipulates reserve requirements, the CRR we looked at earlier, and the statutory liquidity ratio, or SLR. The SLR is the exact percentage of deposits commercial banks must keep internally as liquid assets, like gold or government bonds. Raising the CRR or the SLR mechanically locks up bank capital. It immediately lowers the mathematical ceiling on loans the banking system can create. Quantitative methods do not discriminate. They are blunt force instruments designed to adjust the overall economic temperature of the entire nation. Reference visual. When the central bank needs to perform surgery, it uses qualitative methods. Here, the system splits. Instead of adjusting total liquidity, these selective tools dictate the exact direction and use of credit in specific sectors. One major tool is the margin requirement, the required difference between the market value of a security and the maximum loan a bank will grant against it. Reference visual. If speculative borrowing gets out of control at institutions like the Bombay Stock Exchange, the central bank tightens the margin requirement. Borrowers must put up far more collateral to get a loan. This chokes off credit to that volatile sector without impacting agriculture or housing. The central bank also utilizes moral suasion. It issues direct advice, urging commercial banks to follow cautious policies or restrict lending to specific industries. This advice carries no legal weight, yet commercial banks almost universally comply, bowing to the massive institutional authority of the central bank. If banks do ignore those guidelines, the central bank moves to direct action. It enacts severe punitive measures, heavily restricting operations or imposing massive financial penalties to force compliance. Quantitative tools dictate the total size of the monetary pie. Qualitative tools allow the central bank to choose exactly who gets a slice, enforcing balanced, targeted economic growth. Printing the physical currency, physically holding the national reserves, and aggressively steering the flow of credit. The structural traditional duties of the central bank build the necessary foundation for every financial transaction in the country. Its dynamic manipulation of repo rates, open market operations, and liquidity ratios acts as the active steering wheel. That relentless daily control over credit dictates the actual reality of the citizen. It controls local inflation rates, dictates job creation, and secures the total wealth of the nation. Because its mandate is stability rather than profit, the central bank provides the regulatory buffer that prevents localized financial risks from escalating into national crises. These internal mechanics reveal the specific levers that continuously recalibrate the financial environment for every citizen and business.